Can we avoid a recession and significant job losses throughout the economy? This is a question that investors and analysts continue to discuss. Of course, there's two sides to every coin. And as we know, we just had the latest US jobs reports come through. 315,000 jobs added. So today we're going to talk about what this means for the economy, the potential implications for the Federal Reserve rate hike that's just around the corner for September, and of course, what did economists make of this latest print and where it leaves us positioned as we continue to try and navigate and land this soft landing? As we go through, drop in a comment below, let us know your thoughts on it all and what you think it means for the economy moving forward. So here's the headline number, 315,000 jobs added in August. We know the month before was over 500,000 jobs added. So we're slowing down in an orderly fashion. Of course, it's nothing like the jobs numbers that we saw consistently put up in the start of the economic recovery throughout 2021. However, we know that Federal Reserve, along with other central banks, want to see slowing down and weakening in the labour market. We know that a lot of the tight labour market is helping to drive upwards pressure throughout in wages and continues to stoke that inflationary pressures. However, this report was a Goldilocks report. It wasn't too hot, it wasn't too cold. We haven't seen a significant slowdown, which of course would put pressure on the economy. We haven't seen significant job destruction throughout. However, we have seen a nice orderly procession, which is going to leave the Federal Reserve in a relatively neutral position moving forward to September. Of course, the question will be 50 or 75 basis points, about an even pricing in the bonds markets of both decisions. So I'd love to know your thoughts on it all. What we know as well is that, of course, the Federal Reserve is anticipating and expecting to see an uptick in terms of unemployment. These record low levels cannot be sustained throughout, particularly as they raise interest rates. They're anticipating to see the unemployment rate tick up. But, of course, this can come as a result of a number of different factors. On one side, you could see it due to job destruction, which is not what they want to be seeing. But on the other side, it can come as a result of increased participation rates. And that's what we saw this month, which was why there was a lot of excitement from economists. In terms of participation, we're at the post-pandemic peak, 62.4% for this past month. Of course, we're still a percent below the pre-pandemic peaks, which was above 63%. But what we have seen is that as we've started to see wages increasing, as we've started, of course, to see some pressure throughout other areas of the economy, and there's significant job opportunities throughout, as the pandemic effects start to fade, we're seeing more people looking for jobs. This is what the central bank wants to see. We'll see if this trend continues on upwards, but increased participation versus job destruction, which of course is the other side of the coin that central banks didn't want to see, was a net positive throughout this August jobs report. In terms of the wage growth discussion, of course, we know that the Federal Reserve wants to avoid this wage price spiral. They don't want to see inflation expectations become embedded throughout the society's decision-making process. And we did see a slowdown in terms of growth for this month. August was 0.3% versus the prior month of 0.5%. We know, of course, the slowdown in terms of wage growth is going to keep the pressure on in terms of employees' cost of living pressures, energy, food, everything continues rising up. We know inflationary pressures are up at that 7, 8, 9% mark. However, it does take the pressure off the Federal Reserve with the wage price spiral risk. And of course, as we know, as wages continue to increase, potentially those firms and those companies will have to raise their prices to offset that. Obviously, if they raise their prices, that's going to drive inflationary pressures, which in turn could lead to individuals asking for higher wages and so on and so forth. That's how the cycle evolves. But what we've seen this month is wage growth slowing. Obviously, it's just one data point. We know that everything playing out in the economy is not going to be decided based on one data point. It's a confluence of factors that the central banks will look at to get an idea about trends. And of course, they want to see sustained moves. They don't just want to see one-off individual ones. And then in terms of the soft landing, that's what the central banks want to see. There's still optimism throughout central bankers in terms of their discussions about whether they can land the soft landing. We know that Jerome Powell just spoke at Jackson Hole as well. What is a soft landing? It's cooling down the job market as well as obviously stoking those inflationary pressures and seeing it come down to that 2 to 3% band sustainably without sending unemployment flying and the economy crashing. We know the unemployment rate rose to 3.7%. Obviously, it was at the record lows of 3.5%, but the unemployment rate is only counting the participation rate of individuals who are actively looking for jobs. And the uptick came along with that increase in participation that we spoke about. So ultimately, what to watch moving forward? First and foremost, if you haven't yet, make sure you've subscribed and turn your bell notifications on. Plenty of videos on the markets and everything playing out throughout the week. Hit that like button as well. But what to watch? In terms of the pros from this job report, the labour market is cooling in an orderly manner. The central banks don't want to see a step climb down and a significant fall off. They want to see that slow, steady procession, and we're starting to see that. We know that obviously we added jobs throughout this past month, 300,000 jobs added, which is good. It means that it's going to begin to continue to ease pressure on the labour shortages, which we know are flowing throughout the economy. Obviously, increasing participation rates is a positive, and as a result of increasing participation rate, it eases a little bit of that pressure in terms of the tight labour market, which allows wage growth to slow if there's less competition for workers. Relatively low layoffs so far. Obviously, we know that in the tech sector, for example, some of those sectors that have had more exuberance over the past period, we've seen layoffs in those areas, but across the broader economy, we haven't seen too much so far. And ultimately, underlying all of it, it seems like the mismatch between supply and demand of workers does seem to be converging. In terms of some cons, obviously there's pressures and risks throughout the rest of the economy. It's not as if everything's flying well and plain sailing. The housing market particularly is under pressure. It is still difficult to get employees all back to the office. Obviously, this is a delicate dance that employers are trying to work out how to do. But if they can't get everyone back to the office, that's going to put pressure on the surrounding service providers as well, whether it's food, whether it's retail, all of these service providers located in the key cities. And in terms of the final con, the Federal Reserve does have less constraints to raise rates quicker in September. They've got the decision just a couple of weeks away now. Obviously, if it was a weak jobs report, maybe they could have taken the foot off the gas. This is much more of a con on the market side versus the economy side, but it could have implications for the stock markets around the world. I'd love to know your thoughts. Drop in a comment below. There's a link to another video that you can check out after this one, talking about the macroeconomic picture and where things may head from here. I hope you enjoy it. Thanks for joining us. For now, stay well and happy investing.